Welcome to Biz Wire. I'm Joseph Nordstrom in Beijing. In a move towards internationalizing China's currency, the yuan or RMB, the State Council said it will unveil an operational plan this year to make the currency fully convertible under capital accounts. Now, currently, China only allows a limited number of financial institutions to buy stocks and bonds overseas, as it fears demolishing its currency curb could trigger a capital flight and lead to instability of the financial market in the world's second largest economy. China's cabinet pledged on Monday to steadily introduce market-oriented interest rate and exchange rate system reform measures, permitting individual investors to buy foreign equities and mapping out plans to make the Chinese yuan convertible under the capital account. Yao Wei, China economist with Société Générale, said it is not a surprising move as the regulators have been inching towards an open capital account for some time. Yao says an open capital account will make China's financial market more efficient, more transparent, and up to international standards. Since China's cabinet did not provide a roadmap or specific timetable regarding easing control over the yuan, analysts believe the authorities will deal with the currency cautiously, as they always have. The People's Bank of China, the central bank, published a study last year championing a cautious but forward-looking approach, recognizing that the country had already made significant achievements in liberalizing capital movements while maintaining a stable financial system, and risks for further deregulation are manageable. Liu Ligang, chief Greater China economist at ANZ Banking Group, said, though, that no one said China would make significant moves this year, and that he believes this year is not a good time to open the capital account. Liu said that capital inflows to China have been surging, as indicated in recent trade data, and with major central banks pumping cheap money into financial markets, relaxing capital regulation would entice more inflows given the big spreads between Chinese and foreign interest rates. A Reuters analysis of official data indicates that $181 billion in so-called hot money portfolio investment flows entered China in the first 3 months of 2013, but that estimate may understate the true figure since it doesn't include inflows that many economists suspect have been disguised as trade payments. Yu Yongding, a well-respected economist at the Chinese Academy of Social Sciences, a think tank, expressed worries about freeing capital flow as well. Yu said China should not rush to fully give up capital control. Yu said in a time of economic and financial uncertainty, the capital control is a firewall, and though that firewall is leaking, it's better than not having one at all. While the yuan is already convertible under the current account covering trade, the capital account, which covers portfolio investment and borrowing, is closely controlled. Liberalization of the capital account would allow businesses or individuals from home and abroad to freely convert their currencies to buy assets and equities across the border. Economists said to facilitate the liberalization of the capital account, China must ratchet up its financial reform, which means higher efficiency, stronger competition, a bigger bond market, and lower risks involved with local government's debt. Chang Jian, China economist with Barclays Capital, said that cultivating the bond market will improve the country's financial efficiency as well, as big companies can get funding directly by selling bonds, while state-owned banks will more likely lend money to medium-sized and small enterprises which are cash-strapped. Beijing will likely tread quite carefully, first reforming China's domestic financial system and only then moving in a gradual step-by-step process towards opening its capital account and promoting the yuan's use internationally. Well, this is Biz Wire on the Blue Ocean Network. Stay tuned for more in Economic Insight.